We've all heard the buy low, sell high investing axiom, and while buying the dip is a relatively straightforward investment strategy, successfully executing it is a lot harder than it looks. But what if you could harness the power of artificial intelligence to remove the guesswork? Joining us now to discuss a recently launched ETF that's designed to do just that is CEO at Kaiju ETF Advisors, Ryan Pannell. Welcome, Ryan, and thanks so much for joining us.
Thanks for having us on today.
Well, finding oversold stocks, buying them when they're down, and then flipping them for a profit after they rebound is most certainly an ideal scenario. But for the typical investor and even advisor, it's not an exact science. It's riddled with guesswork and timing risks. So how has DIP removed that guesswork?
I think primarily it does so by being able to identify authentic dips. So buy the dip is not a new strategy. It's a fan favorite from the retail investor up to the fund manager side. The challenge becomes, what's a tradable dip? So you're really talking about a stock that becomes artificially oversold, and you get this mean reversion from low to high, this little pop to the upside. And so you're trying to buy it when it's at its low point and then, ride it up. The challenge is that not all sell-offs are artificially oversold conditions. So if you've seen something at its previous all-time high and then it sells down, that may be the mean reversion right there. So if you buy it there, it's not going to pop back up. It's actually had an inverse correction. So when we talk about artificially oversold conditions, they're usually conditions in which there was an intraday liquidity pocket or void that a high-frequency trading firm with the weight that they carry is able to exploit. There's this fast, violent sell-off. It can be intraday. It can be over a couple of days. And then usually that sell-off will collide with an institutional buy zone, and heavy accumulation will occur. And when you've got a $10 billion HFT running head-on into a $2.6 trillion asset manager, that collision only ends one way. And that's with the asset manager arresting the descent and sending the stock back up. And so that pattern is something that the AI is good at finding within the data that we all consume: price, time, and quantity. And I further offer this basketball in the swimming pool analogy that I've been fond of lately. So if you picture that a basketball floating on the surface of a swimming pool is like a stock at its fair market value as determined by the market participants in that stock at that time. Now, it can go up and down. You can add water to the pool. You can remove water from the pool, but the basketball still is floating on the surface of the water. Now, if I put my hand on top of the basketball and I push it underwater, now it's artificially under the surface of the water. I've got it down there. It could stay there, but only so long as I keep my hand on it. As soon as I pull my hand off, it's going to pop back up to the surface and return to its fair market value. So that's what DIP is trying to do. And it can do that because it's able to perform 2 billion discrete examinations every day before it rebalances the portfolio. And that's something that would be very challenging for a human to do, to say the least.
Got it. Now let's take a deeper dive into the AI or artificial intelligence that's powering the DIP ETF. Of course, not all AI is created equal, and instead of using a single brain, DIP uses multiple brains. Can you tell us more about that?
Yeah, we talk about artificial intelligence all the time like it's just this one thing, like it's a box on your shelf, or internally and in interviews we call it the machine, as if it was just a single thing, and it's really not. It's a whole bunch of layered technologies on top of each other. And the way that AI systems like ours work is a collaborative collection of what we call neural nets, which is just a fancy way of saying like little brains. And so each neural net is tasked with a specific goal, a specific thing that it needs to solve for. So in our universe of stocks that we consider, which are largely the S&P components, we've got at least 2 neural nets that are active on each stock, an upside and a downside neural net. We run 2 other discrete neural nets. One is called regime classification, And then there's regime change detection. So classification is just asking, what do I think is the regime that I'm currently in? Am I bull, bear, or neutral, or I don't know? And then change detection is constantly saying, based on what I'm seeing right now, what do I think is coming next? That's about as close to a crystal ball as we get. There's no guarantee, but that's what it's trying to do. And then we run those brains at a sector, an industry, and a broad market level. So you have thousands of neural nets dealing with everything from Netflix or Disney or whatever, or IBM or whatever they're looking at a discrete level, and talking up the food chain. So whether the classification or change detection engines are finding favorable conditions within Disney doesn't determine whether or not the sector or industry engines find favorable conditions across the industry. So you could be trying to solve problems just at the discrete level. Yeah, that doesn't look great for me. I don't think we're going to add it to the portfolio. Whereas if you have, let's say, in a localized collapse, the most recent being the regional bank collapse in the United States this past spring, now you'll have classification and change detection engines firing from the financial sectors all the way up through the sector and industry and up into broad market, all sort of agreeing that there's challenge here. So that's how they're all collaborating together, and you get yes, no, up and down, add, subtract at the discrete level, and then within the sectors and industries, broad markets as well.
That makes sense. Now, giving money managers the flexibility to enter and exit positions based upon market conditions is often sold as one of the benefits of actively managed portfolios. How does DIP compare to active management, and what types of market conditions is it built for?
I would say that you could probably appropriately classify DIP as extremely actively managed. So it's not, I think normally when you think about active management, you're thinking about maybe monthly, more likely quarterly rebalances, a team of analysts and managers that are culling through fundamental data, reading analyst research, conducting sector and industry analysis, etc., to determine adds, removals, or reweightings within the portfolio. But DIP does not work like that. And in fact, AI is not very good at that type of management. Because I like the analogies here, let's use another one. It would be like if you had AI driving your Tesla. So you're in a self-driving car, and the AI is responsible for that. Do you really want it to analyze the road conditions like once every 3 minutes, or it'll just review once every 5 minutes? Or do you want it to do it like 1,000 times a second? Do you want it to do it 1,000 times a second? And so it's very similar to what DIP does. So DIP is daily rebalancing. Because it has access to, we ingest the market every day at the tick level, and we compare that to 220 terabytes of tick level historical data. The system conducts 2 billion discrete examinations before rebalancing every single day, and that's what helps it makes its decisions on what to add, what to subtract, and what to reweight. And that is actually where AI is strongest. It's strongest in the very short term because those are the patterns that hold up the best. You have an AI system and you ask it, where do you think Microsoft will be in 3 months? It has no idea whatsoever, not a clue. But depending on the market conditions, it can have relative certainty of where it might be tomorrow or the next day. So that's what DIP uses. It's very short-term mean reversion, 1 to 7 days generally. But as you say, very, very active.
Switching gears, let's talk now about the composition of DIP's portfolio. How many stocks does it own, and how often does the portfolio change?
So generally, it'll hold in the 20 to 70 name range. We rank, so again, we're looking for specific criteria that we find have a high correlation to this low to high mean reversion. So it's not going to include names that are on a tear, that are running away. You know, when AI burst out in the spring and you had about 9 stocks out of the S&P leading that charge, they weren't included in DIP's portfolio because none of them were in DIPs beforehand. So it sticks to its trading ideology. It's not going to suddenly put on its Momo hat and say, wow, that's really running. I think I'll go buy that. It's looking for these specific conditions. And we categorize our picks in 5 tiers. So tier 1, 2, 3, 4, 5. And in our development of DIP, we found that tier 1 and tier 2 were fairly reliable and contributed positive P&L. Tier 3, 4, and 5 were still good, but they didn't change the P&L profile over time. They just used more money. So when you're talking about excess capital, so let's take an example. You have a market condition that's not overly favorable to dips. So you're getting a low number, 20, less than 20 perhaps. And because we have specific weighting and diversification rules within DIP, you end up with potentially an excess capital scenario. And our custodian asked us when we first invented DIP, what is your policy for excess capitalization? So you've got like what, just cash sitting there doing nothing? Well, that's not very responsible as an asset manager. We had the option of using tier 3, 4, and 5. But as the manufacturer, we knew that we weren't going to add positive P&L if we did that. We knew that that wasn't to the investor's benefit. It was just justification for holding more money. And we didn't think that that was responsible on a functional or ethical level. So what we also use is a weighted blend of index ETFs. When we can't find enough dips outside of tier 1 and tier 2, or within tier 1 and tier 2 to make up the portfolio, we use this weighted blend of large cap index ETFs that we believe will outperform any one of those index ETFs over the long term. So because it's a weighted blend, it's not going to outperform the leader in the moment. If the Qs is on a tear, that's going to outperform the weighted blend. But if you were to look at the Qs or diamonds or SPY or whatever it is over the long term, our belief is that the weighted blend is a responsible way to use the capital, give some outperformance, we hope, and still be well diversified, which is part of our investment ideology.
And how do you see investors and advisors using an ETF like DIP inside a diversified portfolio?
Well, we've never been a proponent that, DIP should be like a huge holding or your only holding. Just like I'm sure I'm sure the creators of SPY wouldn't say that that's it. That's your portfolio. Just that you're just going to hold that. So our goal with it was to add outperformance to broad index beta tracking offerings. So it doesn't matter what you're using to track, let's say the S&P, which is our benchmark. You're probably allocating a responsible and conservative amount to something, whether it's SPY or IVV or whichever vehicle you're going to use to do that. And what we designed DIP to be was complementary. So instead of that whole allocation to something that's going to broadly track the S&P, maybe consider adding some portion of that allocation to DIP. DIP uses the exact same components. It has very robust risk mitigation mechanisms built in. Certainly if you look at our last 90 days, we're almost double the S&P. We've outperformed every other index ETF. So it is very capable of doing that in market conditions that aren't just runaway. So the last 90 days have not been a runaway market condition, not been overly favorable to anybody. So you're using the same components, but what we're doing is we're trying to opt in and opt out, which obviously the index ETFs are not doing. They're just a buy and hold scenario. So maybe you would start with 10% of what you were going to allocate to that type of an ETF in DIP, try it out, see if it gives you that little bit of outperformance, that little bit of edge. And then over time, we hope, allocate more and more to it. But we really just never saw it at a point where it displaced the other, because they're designed to do different things.
All right, we need to leave it there. Thanks so much, Ryan, for sharing insights, and we look forward to catching up with you soon.
Thank you very much again for having us on. It's been great to be here.
To learn more about DIP and Kaiju ETF Advisors, be sure to visit KaijuETFadvisors.com. I'm Thalia Hayden, and we'll see you on the next episode. Thanks for watching.